Palantir, a great company with an overvalued stock? Palantir is a phenomenal company with cutting-edge technology, but at $125 per share, it's trading at a 675 PE ratio and a $312 billion market cap. Even the most optimistic growth projections struggle to justify this valuation. Let's break it all down. Make sure to like this video and subscribe for more deep dive stock analysis. It really helps the channel grow. Let's be clear, Palantir is an amazing company. It has deep ties to the US government, a rapidly growing commercial sector, and some of the most advanced AI-driven data analytics in the world. Its revenue is growing, and its profitability has improved. But does that mean the stock price makes sense? Here's where things get concerning. At $125 per share, Palantir's market cap sits at $312 billion, yet it generated only $463 million in net income last year. That puts its PE ratio at a staggering 675. For context, a high-growth tech stock like Nvidia trades around 40 to 60 times earnings. Palantir's PE is over 10 times higher than that. For Palantir to grow into its current valuation, it would need to increase net income by 20 times just to trade at a reasonable PE of 35. That assumes near-perfect execution, no competition, and sustained government contracts, all while maintaining sky-high profit margins. Even if Palantir grows earnings at 30% per year for a decade, it would still struggle to justify today's price. We've seen this before. During the dot-com bubble, Amazon's valuation hit extreme levels, peaking at around 66 times sales, far beyond fundamentals. After the bubble burst, Amazon's stock fell 88%. Palantir price-to-sales ratio is almost double at 112. While Amazon ultimately became a trillion-dollar company, investors who bought at peak valuations had to endure years of losses before seeing real gains. The lesson? Even great companies can have dangerously inflated stock prices, and history suggests that a 675 PE ratio for Palantir is unsustainable. Palantir is already down 20% from its highs this week. But even at these levels, the stock is still trading at extreme valuations. Let's consider a more reasonable multiple. 50 times earnings. Even at this still high valuation, Palantir's stock would need to drop to around $9 per share for the numbers to make sense. While the company has strong growth potential, even at 100 times earnings, the stock would be worth just $18, an 85% drop. When valuations reach these extreme levels, investors need to ask, is this the next Amazon, or is it a repeat of the dot-com bubble? History tells us that when stocks trade at 600-plus PE ratios, a correction is almost inevitable. The question isn't if Palantir will come back down to earth, it's when. Palantir is an incredible company with a bright future, but its stock price has gotten way ahead of reality. Will earnings catch up, or is a major correction coming? What do you think? Let's discuss in the comments.